A couple of weeks ago, Merlin released their financial statements for the 2025 season, and as an A-level accounting student, I thought it would be suitable for me to analyse those statements and see what we could get out of them, and just kind of have a general chat about how they did in the theme park season last year, and how they could go on and what their future investments could look like. So if you do go on to enjoy this video, then please do consider subscribing to the channel, and let's get into it. So here we are, we have the Merlin Entertainment's annual report and accounts for 2025. So we're just going to be having a general look about how they did in the financial year and whether they lost money or they gained money, and just kind of how they generally are with managing their finances and what they basically did with their money and how they could basically use the money that they got to plan future investments. Although obviously they could do something completely different to what I'm guessing, but you know, we'll see how it is. So yeah, let's get into it. So now we have just kind of a general contents page. I have looked at annual reports and accounts for other companies in my lessons, so I've done like Next and stuff, so I do know like what the kind of statements and stuff all show. But so yeah, we have just kind of an overview of their numbers. For basically they have 131 attractions, which is probably dwindling at the moment because considering they're probably going to sell some of their midway attractions like discovery centres and stuff like that. But yeah, they got 22 countries they operate in, 5,847 hotel rooms. So I'm not going to be going into detail about every single page because it would be here for hours, but just kind of the main, I guess, income statements, the cash flow, that's also important, operating review, and or to do an auditor's report as well, because that's kind of some external which basically views Merlin's financial statements and basically judges how they did. So yeah, let's go. So they had 60.5 million visitors, which is a decrease of 3.6% on last year. Now what's interesting is they actually made less revenue than last year. Now by the way, this is for their whole company, so this is not just the UK branch, but this is like the company in general, because obviously they do operate kind of parks outside of the UK. I know obviously the UK is their main market, but they do operate parks outside of the UK, such as the Peppa Pig lands in America and stuff like that. They also operate Hyde Park and Gardaland in mainland Europe, and just kind of general other attractions like that scattered around the world. So yeah, that's just in case you're thinking, what, they made £2 billion in just 4 parks? No, it's just like the general company as a whole. So yeah, if they made less revenue, which is quite interesting. I don't really see how they made less revenue considering they increased the price of everything. I guess they're just kind of visitor numbers, which is obviously 3.6% compared to a loss of about 3% for visitors, so revenue. So I guess it makes sense. EBITDA is earnings before interest, tax, depreciation, amortization, which is basically kind of the over kind of overview of the income and loss before, because interest is basically what they pay on loans, and tax is just kind of what they pay to the government, obviously, and then depreciation is basically, it's not a cash cost because depreciation is their assets that they have depreciating over time. So basically all their rides, all their buildings, that loses value over time. Sometimes buildings do increase in price, but most of the time it's a decrease in price for most of the assets. So that's why that's not really included as a cash cost, because you're not really losing physical money, you're just losing value. And amortization is basically the same thing as that. But it's good that they did make an underlying operating profit of £266 million. Now, they did make less profit than last year, but I think it's good that, you know, they're still having around that range. There's not really a massive drop compared to last year. They actually did have an operating loss of only 58 million. Compared to 2024's 132 million loss, so I guess that is a positive. Considering they made less revenue, the fact that they had an increase in obviously it's still a loss, but it's progress, and that's probably due to the selling off of Legoland Discovery Centres and stuff like that. Now this is just kind of corporate, basically. About kind of their theme parks, their Legoland parks, gateway attractions, which is like the midway, the dungeons and whatever. And yeah, this is basically just an overview of all the parks they do own. So obviously they have the Legoland parks in North America, UK, Europe, Asia. Then they have the separate resort theme parks. So that's obviously the ones in the UK, Alton Towers, Thorpe Park, Chessington. And then they also have Gardaland, Heidi Park. And then they also have an overview of the gateway attractions. Obviously Sea Life, there's a few of those around. Yeah, 11, 10, 13. So that's probably one of their most popular brands, I would say, because obviously aquariums are they're not really a popular kind of destination for kind of leisure, I guess. And so it's good that, Merlin continue to operate those. And obviously Discovery Centres, but obviously it says at the bottom that they sold them in February 2026. So yeah, they only have 2 of those in the UK, one in Manchester, one in Birmingham. So yeah, I didn't realise this. They actually had 15 Discovery Centres in North America. That was actually quite a lot. I wasn't expecting that. 5 in Europe, 7 in Asia and the Pacific. Obviously Madame Tussauds, that's quite big. They only got 1 in the UK. That's obviously in London. They got Dungeons, and then obviously the London Eye, Peppa Pig World, as I said before, and then Warwick Castle. So yeah, that's just kind of an overview of the parks they do own and how they did, and like if they sold any of them or got any new ones or stuff like that. Obviously this is a overview from the CEO, Fiona Eastwood. Now obviously, as Merlin Entertainments is a private limited company, so they don't actually sell any shares, and they don't have a like a market where you can buy Merlin shares or whatever. So yeah, so that's why they have a CEO, and it's not just obviously all limited companies do have a CEO, but it's not like a board of kind of shareholders and then they like appoint the leader. It's kind of a more private discussion basically. So yeah, since my appointment as Chief Executive Officer in 2025, transitional year, that's what they all say. Transitional year is basically a translation for we had to sack off loads of people and we just had to try and make do with what we had. So yeah, stabilising the business because the operations are rubbish. So yeah, just kind of corporate, yeah, basically just kind of saying, oh yeah, we basically, they should kind of like make themselves out as, oh yeah, this situation was given to us, we tried to do what we could, instead of like, obviously they can't say, oh yeah, we sacked off our entertainment and we increased the prices through the roof, and oh we, they can't say that obviously, so they're basically trying to make it sound better as they can. This is interesting. So their 26 pipeline includes obviously the Blue roller coaster, Paw Patrol Land, and then they basically have new Legoland coasters in Florida and California. The Lego Galaxy Land. Here they talk about Minecraft. And Legoland Germany, they have a world's first Lego Harry Potter land. I didn't actually know that, to be fair. So yeah. And then basically just move on to their kind of strategies and strengths and what they say their business model, what they basically say they're good at, even though they really aren't. Sorry, just need a drink of water. If you want to pause the screen at any point, you can just kind of read what it says in detail. So delivering our ambitions, basically just kind of what they want to do. But yeah, it's just kind of, most of this is not that significant to the general kind of park goer. Like no one's going to read all of this. So if we move on to, oh wait, what is this? Financial and operating review. So this is basically, is this the, no, this isn't the income statement, is it? No, it's just kind of different thing. Oh, okay. So yeah, so basically have split income statements about EBITDA, which is what I talked about before. So in Europe, they actually got 1 million less visitors, which from last year, which is actually kind of crazy. I didn't think it was that bad. Globally, the staff costs haven't really gone up. They managed to decrease other costs by 1 million. But we also got cash flow, which is basically cash that they spend and cash that they gain. So that's not including kind of the money, like physical. They're not like profit and stuff. It's basically like capital expenditure, like building new stuff, like acquisition, obviously interest, and stuff like that. So the operating cash flow was an inflow of 487 million, but then which was from a bit to 521 million. So that's not that bad, but then that's not including all of the costs and whatever. So their net assets is basically all of their assets and liabilities. So an asset is basically something that you own and it has value to it, whereas a liability is something you have to pay. So yeah, liability is something like they have, and with that they have current liabilities and non-current liabilities. So a current liability is something that is a short-term kind of payment. So like say you bought something on credit and then they say you have 3 months to pay, that's a current liability because it's short-term and less than a year. But a non-current liability is a longer-term payment. So that could be taking out a loan or a mortgage or something like that. So that's going to be longer than a year. So it's like paid over a long period of time, basically. Risks and uncertainties. Health, no one cares. There's so much of this is... Oh, okay. So that's a statement of cash flows. It's basically... yeah. So consolidated income statement, this is basically the most important thing. So cost of sales actually went down by 4 million, which I guess is due to selling off stuff. Less gross profit because obviously they had less revenue like we talked about before. Staff expenses went up by 6 million like we talked about before. Other operating expenses went down because obviously they sacked off everything. EBITDA we talked about. Depreciation was actually 100 million less, which is surprising actually. But yeah, operating loss was, so that's basically like the underlying figure. Like, did they lose money or they gain money? They lost 58 million throughout the whole year. That's the most important figure we really have to look at. Because that's obviously not including finance costs, which was 376 million, which is actually kind of crazy. They made 8 million from income, but they lost 376 million of that. So the loss before tax was 426 million, which is kind of crazy. It was a gain of 66 million from last year, but it's still like really bad. And then taxation means they did lose 406 million. So yeah, I think they can't really carry on like this if we think about it. Because, you know, it's just like losing all this money and then they're not really making an effort to gain it back. So it's just like, I don't know what they're going to do, considering they obviously have the Minecraft area which next year at Chessington, which should increase the visitor numbers a quite fair bit, but will it be enough? I don't know. I'm just click on every like graph so you can pause if you want. But I don't know, it's just like, you know, obviously Merlin has been the UK's leading operator for a really long time, and so I think that with Universal coming in, they really have to either change what they're doing completely or they're just going to get killed by Universal. So I don't know what they're going to do business wise, or what kind of offers and stuff they could offer. But yeah, it's so I'm really interested to see what they could do, because obviously from an accountant point of view, you cannot keep losing money over and over each year, because you obviously, the only way to get out of losing money is either like taking out loans or whatever. So yeah, I just I have no idea what they're gonna do. So I don't know. I mean, it's interesting. It's definitely going to see, like, obviously they have Portons Park and Drayton Manor, which obviously are competing with them. So it'll be interesting to see how much they kind of like fight them off on whatever in terms of Universal, because Universal is like the biggest, one of the biggest companies in terms of the theme park industry. So them coming in is really gonna make them properly think, because they obviously have to change what they're doing, because they can't keep doing the same thing, which obviously means that they lose money, as we can see. So yeah, it'll be interesting to see what happens, but yeah, there isn't really anything too much to look about now. I don't think there's much to that's interesting to the general public. No. Okay. So that was just an overview of the Merlin financial statements. I hope you did enjoy. And cue the outro. So that was an overview of the Merlin financial statements for last year. I don't know what's going to happen in the future, because obviously Merlin has lost money over and over again, as we saw. So it'll definitely be interesting how they adapt to the new competitors they're having, obviously with Portons going through a more thrill market transition. So it'll be interesting to see what they kind of do to rival that, and if anything really, because obviously Portons is down south, and south they have Thorpe Park and Chessington in a sense, with the coasters they have got in recent years. So yeah, it'll be interesting to see the competition and how that kind of plays out in the near future, obviously with Universal. So yeah, it should be interesting. But thank you for watching, and I'll see you in the next one. Cheerio!